Sarah was 31 years old when she left her marketing job for a better opportunity across the country. She was excited. New city, new salary, new chapter. But there was one thing she almost forgot about: the $42,000 sitting in her old employer's 401k. A coworker warned her, "Don't just cash it out." And that one piece of advice saved her from a massive financial mistake. Today, we're going to walk through exactly what Sarah did, the 4 options anyone has when they leave a job with a 401k, and how to protect every dollar you've worked hard to save. Here's something a lot of people don't know. When you leave a job, your 401k doesn't vanish. The money is yours. But the old employer's plan doesn't have to keep your account forever, especially if your balance is under $5,000. Sarah's first instinct was to just leave the money where it was and deal with it later. That's actually what millions of Americans do, and it often leads to forgotten accounts, high fees, and limited investment choices. The good news is you have 4 real options, and understanding each one is the key to making the right move. Let's break down each option. Leaving your money in the old plan is easy, but you may face higher fees and fewer investment choices. Rolling into your new employer's 401k consolidates everything and keeps things simple. Rolling into an IRA, that's an individual retirement account, gives you the most investment flexibility and often lower fees. And then there's option 4, cashing out. This is what Sarah almost did when she saw that $42,000 balance and thought about her moving expenses. But here's what would have happened. She would have owed federal income tax on the full amount, plus a 10% early withdrawal penalty. On $42,000, that could have cost her over $13,000. Let that sink in. On Sarah's $42,000 balance, cashing out early could have meant losing more than $13,000 just to taxes and penalties. That's assuming a 22% federal tax bracket, plus the standard 10% early withdrawal penalty for anyone under 59.5. And that's before state income taxes, which vary by state. According to IRS data, billions of dollars are lost every year by Americans who cash out their retirement accounts early without understanding the cost. Sarah almost became one of those statistics. She didn't, and neither do you have to. Sarah decided on a rollover. Smart move. But here's where a second trap shows up that catches a lot of people off guard. There are 2 types of rollovers: direct and indirect. A direct rollover means the money goes straight from your old 401k to your new account. You never touch it. No taxes withheld, clean and simple. An indirect rollover means the check comes to you first, but the IRS requires your old employer to withhold 20% automatically. So if Sarah had taken an indirect rollover on her $42,000, she would have only received $33,600. She'd then need to deposit the full $42,000 into the new account within 60 days, coming up with that missing $8,400 out of her own pocket. Always choose the direct rollover. Let's look at the real long-term cost of cashing out versus rolling over. This chart shows what $42,000 could grow into by age 65, depending on what you do with it. If Sarah rolled her $42,000 into an IRA and it grew at the historical average stock market return of roughly 7% annually after inflation, she'd have around $225,000 by age 65. If she cashed out and only kept $29,000 after taxes and penalties and invested that, she'd end up with significantly less. And if she spent the cash, that's $225,000 gone. The rollover isn't just about saving money today, it's about protecting your future wealth. So how did Sarah actually do this? Here's the exact process, step by step. First, she decided to open a Roth IRA, but more on that distinction in a moment. She opened the account online with a major brokerage before doing anything else. That's important. The destination account needs to exist first. Second, she called her old HR department and requested a direct rollover, giving them her new account number. Third, the funds transferred within about 2 weeks. No check, no taxes withheld. Fourth, she logged into her new account and invested the money according to her chosen allocation. The whole process took about 3 weeks and cost her nothing in taxes or fees. Here's where Sarah had an important decision to make. Her old 401k was a traditional, meaning contributions were pre-tax. She had 2 main rollover paths. Rolling into a traditional IRA means no taxes due now, the money stays tax-deferred. Rolling into a Roth IRA means paying income tax on the converted amount now, but all future growth is tax-free. Sarah chose the Roth IRA because she expected her income and her tax rate to be higher in retirement than it is today. This is called a Roth conversion, and for younger workers in lower tax brackets, it can be a powerful long-term strategy. But it's a personal decision. Consider speaking with a tax advisor about what makes sense for your situation. This chart illustrates a key concept behind Sarah's Roth decision. Both accounts start with the same $42,000. Both grow at the same average rate. But with a traditional IRA, you pay taxes when you withdraw in retirement. With a Roth, qualified withdrawals are completely tax-free. Assuming a 22% tax rate in retirement, the after-tax value of the traditional IRA is noticeably lower. This is why many financial educators suggest that younger workers in lower tax brackets often benefit from Roth accounts. You're locking in today's lower rate. Of course, tax laws can change, and everyone's situation is different, but this is the data that helped Sarah make her choice.
Here's a staggering number. According to research from Capitalize, a financial services firm, Americans hold an estimated $1.65 trillion in forgotten or abandoned 401k accounts. That's trillion with a T. These are accounts left behind after job changes, often accumulating fees, earning subpar returns, or just sitting idle. The average forgotten account holds around $55,000. If you've changed jobs and aren't sure where all your retirement money is, now is the time to track it down. The Department of Labor's Abandoned Plan Database and the National Registry of Unclaimed Retirement Benefits are free tools that can help you locate missing accounts.
Sarah's rollover went smoothly, but let's talk about where people go wrong. Mistake number 1, choosing an indirect rollover and not getting the full amount back into a retirement account within 60 days. That triggers taxes and penalties on whatever you kept. Mistake 2, accidentally rolling a traditional 401k into a Roth without planning for the tax bill. Mistake 3, and this one is sneaky, the money arrives in the new account but just sits as cash. Sarah almost did this. She logged in 2 weeks after the transfer and saw $42,000 just sitting there, uninvested. Make sure you actually choose your investments after the transfer completes. Idle cash doesn't grow.
Today, Sarah's $42,000 rollover is sitting in a Roth IRA, invested in a diversified index fund portfolio, growing tax-free toward retirement. She didn't need a financial advisor to do the mechanics. She just needed to understand the rules. Here's what we covered. Choose a direct rollover to avoid automatic withholding and the 60-day trap. Understand the Roth versus traditional decision based on your current and expected future tax rate. After the transfer, make sure your money is actually invested. Don't let it sit in cash. And if you've had multiple jobs, check whether you have any forgotten accounts out there. This is for educational purposes only, but this knowledge could be worth tens of thousands of dollars to you over a lifetime.
Everything in this video is for educational purposes only and does not constitute financial or tax advice. Tax rules and retirement account regulations can change. Always consult a licensed financial advisor or tax professional before making decisions about your retirement.